for today, it's going to be quite a lot. We're going to complete that question, and we're going to see how the principles we learn from that question will help us solve the pilot question, SFM pilot question 4, which is on mergers and acquisition. And this is an important topic to know, really, because mergers and acquisition, business valuation is one of those topics that would always show up in exam. It will always often show up in exams. It's an important concept to know. And that's why I like the May 2024 question, because we're able to look at the different methods of valuing a company. And then we can then apply that method to subsequent questions. So we'll do that. We'll do the pilot question 4, which is on mergers and acquisition. And then we will do currency risk management. I'm hoping that we cover all of those 3 today. Currency risk management is very important for your exam. And the reason being that ICAN would always test a question from risk management. And in May 2025, they tested interest rate risk management. In fact, that interest rate risk management was an exact repetition of a past question. And that's why I love question practice. It was an exact repetition of a past question, the one they tested in May. So those guys that would have practiced that question ahead of time would just be smiling when they saw that. But for November, given that they tested interest rate risk, there's a higher chance that they might test currency risk management. So we'll touch on currency risk management today. Hopefully we finish it. If not, in our next session, we would go along with that. Okay, so let's get right back to where we left off in our previous class, which was the May 2024 question. So if you recap from that session, it's that one was that the question required that we write a report. And just like we explained in that session, you'd want to adopt this format when preparing a report. So quite a few elements you must have in. You must have who the report is to, who it's coming from, and then the date. The date could be the date you're writing the exam, which is the exam date, or it could be the account date. And then just a brief introduction, just to state what the report is about. Just a 1 or 2 line is sufficient for ICAN, and then you get that sorted with. We then moved on to look at the different methods for valuing the company that Bolade wants to buy. So Bolade was considering buying Kenny Limited. So we looked at different methods Bolade could approach, he could use to value the company. One would be the net asset basis, which we did. Just look at the balance sheet value and pick the values from the balance sheet. The second would be the net asset basis revalued. What we just do here is when a company decides to revalue some of its assets and decides to maybe get an independent valuer, we look at what is the value of those assets, and that's an important one, because take, for example, in your balance sheet, what you place as the value for your building, which might be the historical cost, might not reflect the actual current value of that building. And so when a company completes a revaluation, you're able to know what the current value of your assets are. And then we use that to determine what our net asset would be. For any asset where we don't have the revalued amount, we make use of the net book value. So we looked at that. Net asset is our total asset minus our total liability. The same thing for the revalued one. PE ratio, very important one to know, because whenever there is mergers and acquisition, it is not complete if they don't bring in PE ratio. And the B, either you use the earning per share or you use the profit after tax. Or the profit after tax. Now, if you use the earning per share, the value you get will be the value per share. If you use the profit after tax, the answer you get will be the total value of the company. Okay, so either of those ones. So we basically use that to do our computation, and then we got the value. Now, one of the things we added in here is that It's not mandatory, but ICAN recommends it. So because we're using a proxy, and the proxy is not listed, but we're applying we're using a proxy which is listed, but the company we want to invest in is not listed, but the proxy is listed, but our own company is not listed. And so because our own company is not listed, I can sometimes recommend or encourage that, which is what is basically applicable really, that we adjust whatever value we get for the disadvantage that comes from that company not being listed. So oftentimes there's a range of between 20 to 30% that we could use to adjust it. So for this example, we use 30%, which is the upper band. You could use 20%, you could use 25%. Just state what you're basically using. Okay, so that's where we stopped from our previous session. So we just get right back to where we stopped, which would be to calculate the value of the company using the dividend yield. And then we'll move on to calculate the value using the present value of future cash flow. So let's do dividend yield quickly. So that's number 4. Okay, so this is, so guys, feel free to raise your hand if you need to ask a question at any point in time, or you need to take me back. That's why we're here. That's why we're here. Okay, so let's look at our dividend yield quickly. Okay, so the value of a company using dividend yield would be the dividend per share. So whatever our dividend per share is, divided by the industry yield. So let's go back to our data and see what's the dividend per share for us and what's the value in the industry. And then that helps us determine what the dividend yield would be, approach would be for this proxy. So let's begin with the dividend per share. Let's begin with the dividend per share. So let's go back to our question for the proxy, which is Kenny. Okay, so we're going back right to our question, to the profit income statement. So Kenny PLC declared a total dividend of 1.1 million. That is total dividend. We're interested in dividend per share as our numerator. So how many shareholders are going to enjoy that 1.1 million shares? Let's go to the statement of financial position. How many shareholders? It has a total of 2.1 million shareholders. So let's see what the dividend per share would be. Then divided by whatever the industry yield, the dividend yield is. So our dividend per share, which is the upper part, would be our total dividend divided by the number of shares. So our total dividend from the income statement is 1.1. Our number of shares is 2.1. Okay, so what is our dividend per share? Sorry, where's my calculator?
0.45.
Yeah, so that's just a minute. 1.1 divided by 2.1. Yeah, so that's 0.5238. Yeah, so we can just make it for decimal places, 0.5238. So that is our dividend per share. Now let's look at if we have our dividend yield in the question, and then based on that, we can then, if we have the industry yield in the question, we can then use that for our computation. So let's go back right to the question. That. Okay, so we're going to just right here. It says the average price earning ratio for listed business in the industry is 9%, and the average dividend yield is 6% per annum. So that's the dividend yield in the industry, 6%, which is 0.06. So let's go right. So our industry yield 6%, which is 0.06. So let's do our value now. So what is our dividend yield? It is a dividend per share, which is 0.5238 divided by our industry yield, which is 0.06. So what do we have?
0.73.
0.5238. Sorry, where's my 0.5238 divided by 0.06. It is 8.73. Someone mentioned 0 point something. How did you get 0 point something?
0.73.
No, 0.5238 divided by 0.06. It is 8.73. Can you reconfirm that?
Yes.
Okay, so it is 8.73. So that is the value of the company based on the dividend yield approach. However, like we explained when we did earning per share, because the proxy is not listed, because the target company Kenny is not listed, we have to do an adjustment to accommodate that difference, and the range would be between 20 to 30%. So since we did 30% for PE ratio, we can do the same thing for this. And we will always do this adjustment whenever you are making use of any industry value. Whenever you're making use of any industry value that is listed, we will always make that adjustment. So let's adjust it for the fact that Kenny is not listed. So Kenny PLC is not listed. Yeah, so we should adjust the value. The value to reflect this. Yeah, we should adjust the value to reflect. Now, I can give the range for that can be used. It's a range of 20 to 30%. So any value between this range is what I would generally recommend. We use 30% for PE ratio. So let's also use 30% for dividend yield so that we are consistent. So that would be 8.73 multiplied by 1 minus 30% of it out. So that would be 0.7 multiplied by 8.73. 8.73 multiplied by 0.7 gives us 6.11. All right, guys, any question on dividend yield? Now, when you understand how this valuation method happens, when you're not doing the remerger itself, it's going to be easy because we're just going to apply the principle. Okay, so let's look at the last one there. Then we can then move on. The last one here would be the present value of future cash flows. Yeah, that's the last one. Now, when we say the present value of future cash flows, we basically mean, so let me explain it a little bit down. Present value of future cash flow. So when we say present value of future cash flow, you look at it that there are two terms involved. There is future cash flow as one thing, and then there's present value as another. So whenever we say present value of future cash flow, what we basically mean, sorry, I want to explain that down. Okay, so when we say present value of future cash flow, what we basically mean would be all the inflow that you expect from the business minus all the outflow. Whatever the answer is, we discount it. So all the inflow minus all the outflow, whatever the answer is, we discount it. That's what we mean by present value of future cash flow. But then there are different presentation format that we could adopt for it. But even if you even stuck with the presentation format, just note that present value of your cash flow will be all the inflow minus all the outflow, and then we discount. Okay, so let's get back to our question and see for this new business that for the new business which is Bolade wants to go into, which is Kenny PLC, what would be the inflow, what would be the outflow, and then we can then discount it out of it. So let's go back to our question quickly so we can do that last bit. So what does Kenny PLC expect to receive as inflow? So this part is Kenny PLC's income statement. So that doesn't really, it doesn't really, it's not really our bit right now, because that is past. That is their record for the past. We're saying future cash flow, not the past. This is the balance sheet for the year that has ended. So it's not our business right now. Right. It now, this is what business, the valuation and all of that. It now comes here and says, read down here. It says, KL Finance Department has estimated that the company's pre-tax, that was before tax, cash inflows for the next 4 years. So you can see that is future, the next 4 years, ending 38 February, before taking account of capital allowance, will be this. So before capital allowance, this will be the net before tax inflow for the next 4 years. So we have that to 2024, to 2025, to 2026, and to 2027. Those values are before tax, meaning that you've not charged tax and we have to charge tax. And those values too, they are before capital allowance and every other transaction. So let's go right into it now by first bringing in what our pre-tax cash flow is. So that's 4.6, 4.3, 5.2, and 2.7 for those years. Okay, so the years would be 2024, 2025, 2026, 2027. Okay, so our before tax cash flow, which is the cash that we expect to come in before tax. Okay, so from what we copied up, it's 4.6, 4.3. These are Naira values. 5.2, and then 5.7. So these are before tax, and clearly every business that makes money needs to pay tax. So let's account for the tax. Then what will our tax be? Okay, so what is our tax rate? What's the applicable tax rate? Let's go right back to the question for our tax rate. Okay. Okay, so it says assume company's tax rate at 21% per annum. So that's that will be the company's tax rate per year. So let's get the tax at 21%. All right, so our tax is 21%. So guys, so calculate up quickly. What will be 21% of 4.6? So that would be 0.21 multiplied by 4.6. So that's 0.966. So just subtract it straight up. We have an after tax of 3.634. Please go ahead and confirm with your calculator as well, just to be sure I have not missed out anything. It's our after tax cash flow. So for the next one, 0.21 multiplied by 4.3, that's 0.903. So we take that from that, gives us 3.397. Next one, 0.21 multiplied by 5.2, 1.092 gives us 4.108. The next one, this is a minus as well. 0.21 multiplied by 5.7 gives us 1.197. You take it off, it gives us 4.503. Okay, now before we proceed, let's even go back to the question and even read other things, maybe so that if there are other details that will come in terms of cash inflow and outflows before we proceed, so that we don't, we can note them out. We've read it. It's been a while we read the question, so let's just quickly glance through to be sure that there are other things, if there are other cash in and outflow that we need to take into consideration, because our present value of future cash flow is all our inflow minus all our outflow, and then we discount. Okay, so this is the income statement. This is the past transaction, so it doesn't affect us. This is our balance sheet. It doesn't affect us. It's a past transaction. We're concerned about future cash flow. These are just revalued amount. We didn't sell any. We are not selling any of them. So it's a revalued amount. It doesn't really affect us. So this is a revalued amount. This is the cost of capital, which we would use when you are discounting. When we are discounting. Here, finance department has estimated that the company's pre-tax cash flows. These are the pre-tax cash flows, which we have already used. But don't forget that this is excluding capital allowance. So we need to bring in the tax savings on the capital allowance impact. So we have capital allowance that we're going to account for here. Okay. It now says that KL's existing equipment has tax written down value of 3.6 million at 28 December 2027. The equipment attracts 18% reducing balance tax allowance. So that ties into this. Capital allowance is at 18% reducing balance. So we'll find what the tax savings is for that. Now it says that this is charged in every year by the ownership of the company except the final year. So please take note of that. We're going to charge that for in every year except the final year, which is 2027. So just take note of that when we're doing a computation. It now says you should assume that KL will not be purchasing or disposing of any machinery in the years 2024 to 2027, and it will dispose of the existing equipment on 28 February 2027 at its tax written down value. So what it basically means is that whatever this final year value is would be the disposal value that is going to dispose at its tax written down value. So that clearly we're expecting an inflow. When you dispose it, money is going to come in. So we're expecting an inflow here from disposal. Let's move on again. It says Bolade's board estimates that in 4 years' time, it could, if necessary, dispose of KL for an amount equal to 4 times its after-tax cash flow for the year to 28 December 2027. So we have identified other things that needs to come in. We've identified the capital allowance that has not been accounted for, the tax savings. We've identified the disposal of the equipment, which money will come in based on whatever the tax written down value is. And then the entire business itself, ALPLC, we've identified that they will be able to sell it for an amount that is equal to 4 times whatever the cash flow is on 28 February 2027. So those are 3 additional cash flows that we need to account. So let's begin to account for them one at a time. So let's begin with the capital allowance. We then move on to the disposal value. We then move on to We then move on to the the sale of the business itself. So let's begin with the capital allowance. Let's calculate our capital allowance and then we calculate our tax savings on that. So there are different methods of presenting capital allowance, but the easier method would be, is the calculation? Yeah. So there are different methods of preparing capital allowance, but the easier method would be for us to find the capital allowance and multiply it by the tax rate to get the tax savings on capital allowance. So let me recap that in our workings. Let's recap that quickly in our workings. So our tax savings on capital allowance would be our capital allowance for the year multiplied by the tax rate. Therefore, for 2024, we'll just find the capital allowance for 2024, we multiply by the tax rate. For 2025, we just find the capital allowance for 2025, we multiply by the tax rate, and so on and so forth. But keep in mind something the examiner wrote here. Please, very important to pay attention to your question. It says that capital allowance is charged in all of the years except the final year. Except the final year. So please, always important to pay attention to the wordings of the question. So let's now begin to charge our capital allowance then. The balance at the beginning of the year is 3.6 million. 3.6 million, we're using reducing balance. So let's calculate, let's see what the values would be then. Okay, so let's calculate what the values would be then. Okay, so this is 2024, 2024, 2025, 2026, and 2027. Remember that in 2027, there will not be capital allowance considered except in that year. So our opening tax written down value. The question says that the tax written down value at the beginning of the year, which is the end of 2023, would be 3.6 million. That would be 3.6 million. Our capital allowance is at 18% reducing balance. So can we calculate what it would be, our annual capital allowance at 18%? Okay, so what is 18% multiplied by 3.6? So this is 18%. Okay, so that is 18%, which is 0.18 multiplied by 3.6. So that gives us 0.648. What is the balance at the end of that year? Okay, so what is the balance at the end of that year? So it would be 3.6 multiplied by 0.648. So that is 2.952. Okay, so what is our tax savings for 2024? It is the capital allowance for the year multiplied by the tax rate. So these are capital allowance for the year. So multiply that by the tax rate to find the tax savings. So that is capital allowance for the year, which is 0.648 multiplied by the tax rate. What is our tax rate again? Sorry, what's our tax rate again? Let's quickly remind ourselves on that.
That's 21%, sir.
Yeah, so our tax rate is 21%. I'm just going by just in case someone has missed it. I know it's 21%, really. Thank you. So our tax rate is 21%. So let's get that as 21%. Okay, so 21%, which is 0.21. Okay, so what do we have as our tax savings for that first year? 0.648 multiplied by 0.21. So it's 0.136. Okay. If you have any question, feel free to raise the hand features or make use of the chat. Let me have a quick look at the chat if there are any questions in there. Okay, all right. Oh, question number, yeah. So this is May 2024, question 1. So we started solving it from the previous class. We just continue where we stopped. Sorry, I missed that earlier. All right. So let's continue for other years. So our closing balance for this year becomes opening balance the next year. So that is 2.952. Annual capital allowance is 18%. So what's 18% of 2.952? 0.12 multiplied by 2.952. That's 0.531. Okay, so what's the closing balance? 2.952 minus 0.531 gives us 2.421. Our tax savings would be whatever the annual value is, which is 0.531, which is the annual value for the year, multiplied by the tax rate. Okay, so what do we have for year? What do we have for year 2025 then? 0.531 multiplied by 0.21, 0.111, or 112 rather, or 0.112. Okay, so let's do that one more time. 0.531 multiplied by 0.21, 0.112. Okay, our closing balance here becomes our opening balance here, which is 2.421. Capital allowance on reducing balance is 18%. So what does that give us? 2.421 multiplied by 0.18 gives us 0.436. Okay, so what do we have? 2.421 minus 0.436 gives us 1.985. Okay, all our tax savings for the year, whatever the annual capital allowance is, multiplied by the tax rate. So that is 0.436 multiplied by 0.21. 0.436 multiplied by 0.21. Okay, so that's 0.302. No, let me check that again. It shouldn't be 0.302 because that one is lower. 5 is the lower, so it can be 0.3 and that is 0.1. So 0.436. 0.436 multiplied by 0.21. Okay, 0.092. 0.092. Okay, our final year, the closing balance here becomes the opening balance here. So that is 1.985. Quickly, guys, are we charging capital allowance in the final year based on the question? Are we charging capital allowance in the final year? Are we?
No,
No,
sir.
question. Yeah, thank you. So we need to pay attention to our reading. So let's go back quickly for those that might have missed that. We need to pay attention to the questions when we read. And that's the good thing about question practice. You get used to paying attention to questions. So the question clearly mentions here, right here. I'm going to read right here. It says, the equipment attracts 18% reducing balance tax allowances in every year of ownership of the company, except the final year. So except the final year. So the final year, we don't have any capital allowance because it's not permitted for that final year. Okay, how am I have this duplicated? Okay, so our capital allowance is 0. Our closing balance is 1.985. Okay, guys, let's transfer these values that we've solved to our calculation quickly first. So let's calculate. So the values are 0.136, 0.112, 0.092, and then the last one is 0. There is no capital allowance for that last one. So right here would be our tax savings on capital allowance. I'm just copying those values in. 0.136, 0.112, 0.092, 0.000. There's nothing in that that here. Okay, so let's go to our question. What X did we mark that involve either cash going out or cash coming in? The question mentions that that equipment that we have, we're going to sell it, which is here, which is right here. We marked it when we were reading our question as the second thing we're going to look at. It says, you should assume that KL will not be purchasing or disposing of any machinery in the years 2024 to 2027, and that it will dispose of the existing equipment on 28 February at its tax written down value. So what is the outstanding balance as at 2027? That is the amount it will sell the equipment. So based on our computation, what is the outstanding closing balance as at end of 2027? Can we quickly go back there? What is the closing balance? Because that is the tax written down value that is going to sell that machine. What do we have? What's the closing balance?
1.985.
1.985. That is the value to sell the machine. So as we read this question, I can see you begin to see that some of these questions, they're not hard. It's just for you to just read it and just flow along and interpret with the requirement of the question. So our disposal of the equipment will be 1.985. $1.985. Now, besides this equipment, the question also mentions the sale of the company itself, which was the last element we need to touch on, the sale of the company itself. It mentions how much it will sell the company itself, besides that, in addition to the equipment itself. So let's read that line, which is the final line, which is this part. When we're reading it, we marked it, so we don't have to be searching for it. So one of the things I advise people to do when you're reading question, try and mark important areas that you're going to use so that you don't have to begin to read them all over again. So you could see when we're reading it, I mark this, I mark this, I mark this as number 3. So I knew where I was looking for next. So let's look at that part I marked at number 3. It says, Boladi's board estimates that in 4 years' time, which is 2027, it would, if necessary, dispose of KL as the company itself for an amount equal to 4 times its after-tax cash flow for the year to 28 February 2027. So it will be able to dispose of the company itself for an amount equal to 4 times whatever the after-tax cash flow is as at 2027. So what is the after-tax cash flow as at 2027? It will be able to sell the company for 4 times that value. So let's go to our 2027 value. What is the after-tax cash flow as at 2027? Can you guys say it? Can you see the after-tax cash flow? 4.503. It will sell the company KL at 4 times that amount. So how much would that be? Four times that amount.
18.012.
So that is 4 multiplied by 4.503. Just give me a reconfirm that on my own calculator as well. So they're all the same point. 4 multiplied by 4.503. So that's 18.01 because am I doing 3 or 4 decimal places? Okay, I'm doing 3 decimal places, so I keep everything consistent. So that is 18.01012. Okay, yeah, 3 decimal places, 0.12. Okay. I think that's the last information with regards to inflow or outflow. But let's double check from the question first to be sure that there's nothing after that. Okay. Yeah, that's the last information before the question. So let's balance. But before we balance, quickly, is there any question on any of the items we just plugged into this computation? Okay, let's go ahead and summarize. Key point is pay attention to the wordings of your question and then just flow along with it. Just flow along with it. It's that easy. Just flow along. Don't overthink it. Just flow along with it. Just interpret, flow along with it. Okay, so let's do what our net cash flow would be, and then our total cash flow would be, and then we can then discount. Okay, this is our total cash flow. So I'm adding everything from the last line, adding everything from the last line, adding everything from the last line. Okay, so the first one, 3.637 plus 0.136. Someone can also help me reconfirm it because sometimes I might punch a wrong value from my calculator. But right now I have 3.770. Someone else could help me reconfirm that as well. The next one, 3.397 plus 0.112. Sorry, just a minute. Okay, 3.397 plus 0.112. I have 3.509. Okay, and then the next one, 4.109 plus 0.092. I have a total of 4.2000. The next one, 4.503 plus 0 plus 1.985 plus 18.012. I have 24.5. Okay, so let's discount. SFM is never complete without taking into consideration the time value of money. So we will always discount. So let's discount. Okay, our discount rate in the question is given to all the cost of capital. What is that? Let's quickly double check on that quickly. Where is the cost of capital? Somewhere right here. Yeah. So the cost of capital to the cost of equity for the business, it's taking into consideration level of gearing is 14% per annum. Okay, so this is 14%. So quickly, I'll just make use of my discount factor table. I'm sorry, I need to mute. Okay, guys, so just make use of my discount factor table. But basically, the formula for our discounting, quickly, discount rate will be 1 divided by 1 plus whatever the rate of return or cost of capital is raised to the power of the year, or 1 plus this raised to the power of minus n. So there are 4 years. So this is year 1, this is year 2, this is year 3, and this is year 4. Okay, so quickly do that like calculator. I'll just make use of a discount factor table. We don't need to. Okay, so at my end, I have 0.877 as year 1 value, 0.769 as year 2 value, 0.675 as year 3 value, then 0.592 as the other value. So what is the present value? So this multiplied by this. Okay. So 3.770 multiplied by 0.877, I have 3.306. 3.509 multiplied by 0.769, I have 2.698. 4.2 multiplied by 0.675, I have 2.835. Then finally 24.5 multiplied by 0.592, I have 14.504. Okay, so what is the total value, present value now? Total. Okay, so let's add up, we add up everything. We add up everything to find what the value is. Okay, so that's 2.306 plus 2.698 plus 2.835 plus 14.504. Sorry, let me take that one more time. I missed something. 3.306 plus 2.698 plus 2.835 plus 14.504. So that is 23.343. 23.343. Right. So that's our different method of valuing the company. Sorry, I need to quickly accept a few guys that are just joining. Okay. Yeah. So guys, you take away from all of us from all of this, just know how to value a company using all of the different methods. And then with that, we can then move on to our next question. Is there any question on what we've just solved right now? As we're moving over to question 4 of the SFM pilot question for November exams. Okay, so I'm pretty sure we're all good. So let's apply this knowledge and move on to the next question. So just give me a sec. Let me call up let's call up the question. Just give me a sec.